the birth of the servicing maze. To understand how today's nightmare took hold, we need to go back to the 199s, when federal student loans made a quiet but crucial shift. Back then, the government didn't yet have its massive digital systems or call centers. It relied instead on a patchwork of banks and guarantee agencies to issue and collect student loans. Millions of young borrowers paid their local bank, not a faceless contractor. Then came a political buzzword that changed everything: efficiency. The Department of Education wanted to streamline operations and reduce costs. The solution seemed simple: outsource loan management to private companies that could handle the volume more efficiently. These companies would collect payments, track records, communicate with borrowers, and manage repayment plans. In theory, the government would oversee the rules while the contractors handled logistics. In practice, the handoff created a middle layer so thick that even the government would struggle to see through it. One of the first big players was Sallie Mae, originally a government-sponsored enterprise designed to support student lending. By the 199s, Sallie Mae had privatized and wanted a bigger slice of the action. It positioned itself not just as a lender, but as a service provider, a company that could manage loans on behalf of the government. When the department opened the door, Sallie Mae stepped through with a sophisticated pitch: let private industry handle the paperwork. Borrowers didn't realize much had changed. They still got bills, payments still went through familiar-looking portals. But behind the scenes, Sallie Mae had started building a massive infrastructure optimized not for simplicity, but for scalability. The goal wasn't personal service, it was volume. Millions of accounts, each treated as a product line. As education costs soared through the late 199s and early 200s, federal lending exploded. Suddenly, the government was responsible for hundreds of billions in outstanding student debt. Instead of expanding its own administrative capacity, it doubled down on outsourcing. New servicers entered the picture: state agencies, private firms, and subsidiaries of big financial institutions. Competition became the excuse for reform. The department promised that by holding servicers accountable through contracts, borrowers would get better service. What really emerged was the contract economy of student loans. Servicers were now paid not based on how much debt they managed, but how many accounts they handled. A flat fee per borrower. Whether a loan was $5,000 or $150,000 didn't matter. Each was just another entry in a digital queue. Every borrower became a unit on a balance sheet. On paper, this made sense. Fixed fees meant predictable costs for the government. But it turned repayment into a game of throughput, not problem solving. To a servicer, the fastest way to resolve a call is to end it. The easiest way to handle a complex repayment question is to offer forbearance, a temporary pause, rather than walk the borrower through confusing income-driven repayment forms. By the early 200s, complaints about lost paperwork and miscounted payments began surfacing. Borrowers couldn't get straight answers about their balances. Federal reporting systems couldn't reconcile data between lenders and servicers. Yet the contracts kept growing. Each time a servicer made errors, the fix wasn't to build oversight. The fix was to bring in more servicers to compete. The maze got bigger. Meanwhile, Sallie Mae split off its servicing arm and renamed it Navient in 2014, a move meant to signal modernization. But structurally, nothing changed. It was still a descendant of the same outsourcing culture that valued scale over accuracy. Navient inherited the largest federal loan portfolio in history and quickly became the face borrowers associated with endless hold times and contradictory information. For millions of people, their student loan journey started right after graduation with a letter saying, "Your loan will now be serviced by insert name." That phrase, so ordinary, marked entry into one of the most confusing bureaucratic networks in modern finance. If you changed jobs, moved cities, or even changed email addresses, your connection to that system could fracture. Miss one communication and consequences snowballed. Payments misapplied, forgiveness years erased, interest capitalized quietly in the background. The first generation of borrowers under this new system felt that something wasn't right. They noticed their balance didn't shrink, even while paying faithfully. But few had the knowledge or the time to decode the rules. They assumed mistakes were their fault. After all, servicers presented themselves as neutral administrators. They rarely admitted error. For every borrower who pushed back, thousands just accepted the confusion. Many of those early borrowers were first-generation college graduates. They believed education was the ticket to stability. What they didn't realize was that their loan wasn't really owned by their lender anymore. It was managed by a contractor incentivized to keep them paying, not progressing. The rules about deferment, forgiveness, interest accrual, all ran through systems designed with minimal transparency. By the late 200s, reports began to emerge from state attorneys general and consumer advocates documenting bizarre inconsistencies. Identical borrowers in the same program showing vastly different payment histories. The labyrinth wasn't an accident. It was the structural outcome of delegating responsibility across corporations whose primary accountability was to their contract, not the people calling for help. The result wasn't just inefficiency, it was a new kind of dependency. Servicers became indispensable to government operations. The Department of Education couldn't suddenly take servicing in-house without disrupting millions of loans. Complexity had become self-sustaining. The harder it was to track where problems originated, the safer the servicers became. What started as outsourcing had evolved into an opaque financial ecosystem running parallel to the government's own operations. Borrowers were told their loans were federal, but every experience of repayment was filtered through private systems, private call centers, and private incentives. And as the balances grew, so did the influence of those managing them. Sallie Mae had turned into Navient, new competitors entered, and the servicing maze cemented itself as an unavoidable feature of student debt. This was the invisible moment when control slipped away. The government technically owned the loans, but it no longer managed the relationship. Borrowers did what they were told, filed, paid, recertified, but the people on the other end of the line worked for companies with different priorities. That disconnect between who owns the debt and who controls the experience is the foundation of the modern student loan trap. In the next chapter, that trap takes shape in full view. Because when Navient's empire began to fall, what spilled out exposed that this wasn't just one company's mismanagement, it was the entire business model laid bare. The downfall didn't just confirm borrower suspicions. It validated years of doubt, frustration, and quiet emotional burnout that millions had already internalized as personal failure. The Navient empire and its fall. When Navient spun off from Sallie Mae in 2014, it didn't leave behind controversy, it inherited it. Overnight, this newly branded company became the heavyweight of the student loan servicing world. More than 12 million borrowers under its care, managing over $300 billion in loans. On paper, Navient was supposed to bring innovation and transparency to a system full of old frustrations. In practice, it replicated every flaw and scaled them to industrial size. For borrowers, the transition looked routine. One day they had Sallie Mae statements, the next, letters from Navient. Nothing about the note itself changed. Interest rates, balances, payment dates all the same. But what did change was the back-end system that tracked their payments, applied them across loans, and communicated with credit bureaus. Those were the levers that borrowers couldn't see, and it was in those shadows that Navient's problems began. Customer service scripts grew longer, call times shorter. Representatives were trained to move borrowers through the conversation cycle quickly. Acknowledge, deflect, offer forbearance, close. Forbearance, pausing payments temporarily, was the cheapest, fastest way to get a borrower off the line. It didn't require detailed income documentation or the maze of forms needed for income-driven repayment programs. It was simple for the company. But every time a borrower accepted forbearance, the unpaid interest piled up, ballooning the total cost of the loan. The Consumer Financial Protection Bureau began receiving thousands of complaints. Borrowers said they tried to enroll in more affordable income-based plans, but were instead guided to short-term pauses that left them worse off. Others discovered payments applied incorrectly, sometimes split across multiple loans in a way that triggered late fees. Some said that supposed credit-building programs after default were exaggerated or misrepresented. By 2017, the CFPB filed a sweeping lawsuit accusing Navient of unfair, deceptive, and abusive practices against millions of borrowers. Navient denied wrongdoing, pledging to vigorously defend itself. Yet the evidence painted a pattern too consistent to be ignored. Internal communications, according to investigators, revealed a company culture optimized around efficiency metrics, not borrower success. Representatives were graded on call times and closure rates. Helping someone enroll in income-driven repayment might take 20 minutes. Granting forbearance took less than 3. The data told management that fast calls were good calls. The financial outcome, debt growing instead of shrinking, was quietly profitable. Meanwhile, borrowers experienced decades-long consequences. Many who had been working toward public service loan forgiveness discovered their counted payments were wrong. Months, sometimes years, vanished from their progress records. Some found that payments had been applied to the wrong loan groups altogether, resetting schedules and erasing headway they thought they'd made. The ripple effects weren't abstract. They determined who could buy a home, who could start a family, who could retire someday. State attorneys general joined the fray, alleging similar misconduct. Investigations found systematic steering into forbearance instead of informing borrowers about better long-term options. Navient's misapplied payments led to unnecessary late fees, damaged credit, and interest capitalization. Millions of borrowers spent years thinking they were on track, only to find out later that they'd been standing still. Then, in 2021, Navient made moves that looked like a retreat wrapped in strategy. It transferred its entire federal loan portfolio to another contractor, Maximus, later rebranded as Advantage. At the time, Navient framed this as an operational handoff, clean, practical, efficiency-driven. But quietly, the CFPB's legal pressure loomed. By early 2024, the agency and more than 30 state attorneys general reached a historic settlement. Navient would pay $120 million in penalties and restitution, and more importantly, it would be permanently banned from servicing federal student loans. The ban didn't admit guilt, but it confirmed what borrowers already knew from experience. That mistakes weren't random, they were business decisions. Navient exited the federal stage, leaving millions of loans to be handled by others. Yet the borrowers didn't feel relief. Their loans were simply transferred again, and many saw the same issues repeat under different names. For regulators, the Navient settlement represented a landmark victory, proof that abusive servicing wouldn't go unchecked. The CFPB called it accountability long overdue. But for borrowers, the practical reality was anticlimactic. The new servicers inherited the same databases, the same opaque systems, and in many cases, the same problems. Lost paperwork, contradictory payment histories, unexplained interest. The names changed, the structures didn't. Behind the fanfare of the ban lay a sobering truth. The systemic incentives remained untouched. Servicers, regardless of their logo, still earned a flat fee per borrower. They still faced low compensation for complex cases and higher rewards for accounts in simple, automated status. The fall of Navient didn't dismantle the structure. It merely demonstrated that any company working within it could slide toward the same tactics. Borrowers affected by Navient's actions were promised restitution, a tiny credit here, a few $100s there. For some, that covered barely 1 month's payment. Others never saw relief because their accounts had long since been transferred or sold. The headlines declared victory, but the scars in borrower records, those miscounted payments and distorted histories, rippled across the system, affecting eligibility for forgiveness programs even years later. Inside Navient, the aftermath sparked internal change. The company's CEO stepped down. Its board promised to pivot toward new business. They meant private loans, debt collection contracts, and financial services beyond the federal system. The brand survived, but its role in student loans ended the way many borrowers' stories had, with silence on hold lines, confusion in the details, and a quiet exit. The fall of Navient stands as a revealing chapter in the broader student debt story. It showed that even when caught, punished, and pushed out, a servicer could essentially hand off its borrowers and walk away clean. The damage, meanwhile, lingered on every borrower's account. It wasn't one corrupt operator bringing chaos. It was the economic logic built into the contracts themselves. If you zoom out, the collapse looks less like justice served and more like a reset button. One bad actor gone, dozens of nearly identical ones remaining. The CFPB ban sent a signal, sure, but also a warning. The true machinery behind student loan servicing is much bigger than any single company. It's a web of incentives, contracts, and political approvals that keeps replacement parts ready whenever one fails. Navient fell, but the system didn't tremble. The same logic kept running, uninterrupted. Every other servicer watched, adjusted language in training manuals, and continued business. Borrowers noticed a new name on their statements and hoped things might finally get better. Instead, they found the same phone trees, the same errors, and the same sense that maybe the problem wasn't who answered the call. It was the system itself. The incentive problem: how servicers get paid. On paper, the student loan servicer's job seems straightforward. Collect payments, keep records up to date, and help borrowers stay on track. In reality, it's a business built on contracts, formulas, and performance metrics that most borrowers never see, and almost all misunderstand. The core of the problem isn't corruption in secret emails or executives plotting to ruin graduates' lives. It's the incentives. The way servicers get paid shapes how they behave, what they prioritize, and how your loan sits on their books for years longer than it should. Servicers don't make money when you pay off your loan. They make money when you have a loan to service. Their compensation comes from the Department of Education, not from you directly. The government pays them a flat monthly fee for each loan account they manage. It doesn't matter if the loan is $50,000 or $15,000. It's the same fee. That alone flips the logic upside down. Servicers earn more by having more accounts under management, not by helping those accounts disappear. Under the 2024 contracts, for example, a servicer earns a few dollars per loan per month, enough to total a few $100s per borrower over a decade. Multiply that by millions of loans, and you get a billion-dollar operation. But the payment varies by status. A borrower whose current generates steady income. A borrower who falls deeply delinquent generates almost nothing. So at first glance, the incentive should be to keep people current. Yet servicing an active, paying borrower takes time, training, and consistent follow-up. Forbearance, in contrast, is effortless. Forbearance pauses payments without fixing anything. When you call about struggling with payments, the agent sees two buttons: forbearance or income-driven repayment. The second option requires paperwork, income verification, multiple system entries, and follow-up calls. The first just requires one click and a script to read. You can guess which one's faster when a call time monitor is running in the corner of the screen. That's the hidden math behind so many temporary solutions. Each borrower moved into forbearance is one less complicated file in the queue. Sure, interest still keeps adding up, but that problem belongs to you, not them. For the servicer, that borrower stays on the books as an active account. The monthly contract fee keeps flowing. It's a short-term when disguised as customer service. Meanwhile, if you try to switch into an income-driven repayment plan, your case can sit in limbo for months. Forms get misplaced, income data has to sync between IRS and education department systems, and errors bounce back and forth across databases. During all that time, interest may be accruing and late notices trickling out. If the process burns you out enough to stop trying, the servicer doesn't mind. You're still their account, and the clock still runs. Borrowers often wonder why representatives sound rushed or hesitant to offer alternatives. It's because call performance overshadows results. Many servicer contracts include metrics: short average handling time, low call escalation rates, satisfactory survey responses. The agent who solves a complicated problem might score worse than the one who politely ends a call in 3 minutes. Multiply that mentality across thousands of reps, and helpfulness gradually becomes a liability. The 2024 contract reform was supposed to fix this imbalance. New performance incentives offered small bonuses for keeping borrowers enrolled in repayment and reducing delinquency rates. But the margins are thin. The difference between an A-performing servicer and a C, one might be less than a few dollars per borrower per year. For a company with millions of accounts, it's cheaper to meet the minimum standard than to overhaul operations. Even with the new structure, the reward for excellence is small compared to the cost of genuine improvement. Think of it like this: the department pays for compliance, not compassion. Servicers deliver reports, process totals, and tick boxes. As long as the data looks tidy in Washington, bonuses go out on schedule. Whether borrowers are actually closer to forgiveness or just treading water, that's harder to measure, so it rarely enters the equation. The people answering phones aren't villains. They're hourly workers trying to hit targets designed for machines. The deeper issue sits inside the contracts themselves. A system that treats every borrower as equal inventory naturally pushes human problems into automated categories. That's why so many calls end with standardized scripts, why your emails sound pre-written, and why we appreciate your patience is code for we have no financial reason to rush. There's also the penalty structure. When servicers make errors, misapplied payments, lost forms, the fines or clawbacks are often smaller than the savings from cutting corners in the first place. The department can theoretically assign lower performance scores, but transfers between servicers can take months and disrupt millions of accounts. Punishment is bureaucratically messy, so oversight stays light. Servicers understand this and calibrate accordingly. Don't break the law blatantly, just make complexity your armor. Borrowers living through this chaos begin adapting emotionally. They treat loan management as a full-time side job, tracking confirmation numbers, scanning PDFs, saving screenshots, because experience has taught them that proof is the only power they hold. Their paranoia becomes survival. Yet all that vigilance happens inside a framework that incentivizes confusion. Every duplicate form, every missing signature, every resubmit in 30 days, notice drags the relationship forward another month. More time, more fees, more profit, and more emotional fatigue that quietly convinces you being constantly anxious is normal. There's one story that captures the absurdity perfectly. A teacher named Janine called her servicer after getting a letter saying she was past due. She hadn't missed a payment in 7 years. After half an hour, the rep admitted a payment had been applied to the wrong loan group. A technical glitch, easily fixed, they said. But because the correction required manual reversal and reapplication, it would take 60 days to post. During those 60 days, interest would keep compounding. The agent apologized, offered forbearance, and asked if Janine wanted to suspend payments to avoid stress. She reluctantly agreed. 6 months later, her balance was higher than before she called. Multiply that by millions of similar stories, and you see how the system sustains itself. The servicer doesn't have to rob you outright. It just has to keep you suspended between confusion and compliance long enough for the math to do the rest. That in-between space, where you half believe it might be your fault and half know it isn't, is where burnout starts. It's not just money being drained. It's your sense of control dissolving drip by drip. The irony is that servicers publicly advertise their mission as helping borrowers succeed. But under their compensation model, improvement is a cost center. When success means losing an account and confusion means keeping one, the moral conflict becomes a business principle. The incentives don't just shape behavior, they define the boundaries of possibility. Policy tweaks have tried to realign those incentives, but without transparency into how profits actually flow, most reforms end up cosmetic. Officials can demand shorter call times or clearer websites, but as long as the basic payment model remains a flat fee disconnected from borrower outcomes, the maze keeps reconstructing itself. This is why replacing one servicer with another never feels like change. The names on your statements rotate, the incentives underneath stay fixed. The structure itself guarantees that complexity pays, and simplicity doesn't. Before anyone can solve the student debt crisis, they have to face that uncomfortable truth. The system isn't broken by accident. It's functioning exactly as it was designed to.